Good afternoon and welcome to today's FTA webinar. Our presenter for today is Stephen Earl. Stephen is the co-founder and managing director of Acuity Capital. Acuity Capital is an Australian company that formed a little over 4 years ago when a small group of ex-Macquarie bankers got together to start Acuity. Acuity has now executed over 20 deals with ASX listed companies. While at Macquarie, Stephen was in the investment banking business and then joined Macquarie's asset and funds management business, where he was responsible for over $2 billion of assets under management. Before joining Macquarie, Stephen was a corporate lawyer at a top-tier firm. Stephen recently relocated to New York, where he met his fiancée, and from where he is delivering this webinar. If you would like to ask Stephen a question at any time, please do so by typing it into the chat box, which is located at the bottom left-hand side of your screen, located to the right of the cogwheel. I'll now hand you over to Stephen to begin.
Thanks, Jeff, and thanks everyone for coming along to the webinar today. So, look, today we're going to talk about managing capital in uncertain times, and in particular, a tool that's available here in the United States called an at-the-market. It's certainly not the only tool available to you, obviously, but it's a tool nonetheless that I think could be quite interesting for ASX listed companies, and certainly interesting to have a look at and have a chat about today. So that's the main focus of today's presentation, and I just am trying to go through here, Jeff. Oh, there we go. And so, look, these are the usual sort of disclosures, which you no doubt have seen before at different presentations. I guess the main one being that this is confidential, and the indicative nature of any of the illustrations here. Obviously, it's not advice. And look, some information about Acuity down the bottom as well. And look, I think Jeff mentioned we're an Australian company, despite my being located in New York, where I did meet my beautiful fiancée. So look, we do all our deals out of Australia and whatnot. But look, just for your information, that is there. So look, let's set the background for traditional ASX listed companies. What we've got is the traditional way to raise equity capital is your standard raising of through the institutional placement route. So you go to someone like my old employer, Macquarie, they'll be able to raise capital for you through a typical placement through the insto superannuation funds and whatnot. There's obviously tapping your own shareholders through pro rata, like a rights issue or an SPP, so a share purchase plan. These have different effects depending on what you're trying to achieve. Obviously, with the rights issue, you can structure a number of different ways. Do you underwrite it? Do you not underwrite it? Are they renounceable? Are they non-renounceable? All sorts of different tools and ways in which you can do it. Do you deeply discount it? All those kinds of questions, depending on what you're actually raising capital for and your aims in trying to do that. And then, of course, there's the DRP. Now, DRP is something which a lot of firms will turn on to reward shareholders and get them involved, I guess, as those dividends get reinvested back into the company. And so these things have a number of things in common, and typically they can be quite expensive. They're not always this way, but oftentimes they can be expensive, they're time consuming, and you can't always time the best price. If you're trying to actually raise a significant amount of capital or even a small amount of capital, depending on what you're trying to achieve, the pricing or the timing of these can be quite difficult to actually make sure that it's getting the best bang for your buck, so to speak. Because obviously the potential for large negative reactions, again, depending on what you're actually raising the capital for, the structure of how you're raising it, and obviously broader issues that are outside the company's control, macro issues, sector-specific issues, and whatnot. And look, regardless of which way you look at it, there's always the potential to be unfair and inequitable, and not that anyone should pay too much attention to what's going on in hot copper, but you'll always find someone there who's not happy, a shareholder who's not happy with the structure or with the deal you've come up with, even though it may in fact be the very best sort of structure for the company. So they're the tools, the blunt kind of instruments that are available to ASX listed companies when they're looking to raise capital for a secondary raising. But I guess what it doesn't do, it doesn't allow the company really to tap what is arguably the biggest part of the market, which is the daily trading of every single stock that's going on in the market at the moment. So right now there'd be someone buying BHP shares at whatever price they're buying at. That market is effectively untapped. It's a market which people can buy and sell shares, but the company isn't really able to actually effectively tap. So this makes for raising capital can be quite, as I said, expensive, it's timely, there's a roadshow, there's obviously due diligence, there's a whole range of things that go into these capital raising, which often mean that the control is handed over to third parties, whether or not it's part of a placement, and then who knows who that's being placed to. Are they going to be a friendly shareholder? Are they an agitator? How are they going to actually view the company in the longer term? And it doesn't necessarily also lend itself to price and timing effectively to let anyone participate, but also get the best possible price. And that's really what capital raising and capital management should all be about. It's about raising capital at the best possible price, efficiently deploying that capital to earn a return, which obviously is what the whole game's about. So what is the answer then? Well, look, let's have a look to the United States. Now, right now, I think the actual third presidential debate's on, so thank you all for coming along and not watching that. I'm going to watch the highlights on Saturday Night Live, but certainly here in the US, there is a solution to this kind of problem that's been around since the 1990s, and it's actually referred to as an ATM or at the market. So an ATM or at the market. And what this ATM or at the market is a secondary stock offering available only to US companies, enabling them to sell newly issued shares into the secondary market. So think about this as in a reverse buyback. And sorry, to take a step back, when I say secondary market, I don't mean going along to the investment bank and saying, hey, do you have a bunch of insto investors that would like to buy stock here? It's actually the trading that's going on in Australia, by Comsec, by E-Trade, whatever platform that people are using to buy and sell stock. Here, when people are using interactive brokers or whatever it is they're using to buy and sell stock, if a company has an at the market or ATM, it can in fact be the company who is selling that person the shares, newly issued shares, to raise that capital. And so how does that work? Well, the company is controlling the parameters. And again, I use that word control. The key takeaway from today's webinar. The company controls the parameters, including the price, the timing, the volume. And when I say timing, it includes the period over which these ATMs or at the markets are actually utilized. Very importantly as well, it's if they are utilized. There's no requirement to actually use an ATM. Unlike other sort of structures, the ATM simply sits there as a tool in the proverbial back pocket that allows the company to turn it on at any time it chooses, at a price it chooses, with volumes that it chooses. So again, if the market is never in a satisfactory position in terms of what they would like to do, then you don't have to use an ATM. So it's a very complementary kind of tool in that sense. So just to give some context, some flavor to the ATM usage in the United States, and we'll get to a bit more detail later. There's about 450 companies have used them to raise about $58 billion between 2012 and 2014, and last year was about $30 billion raised in 2015. Broadly, since these ATMs have been introduced, the trajectory is up. So 2016 is actually down on 2015 in terms of the actual usage of ATMs, but broadly the trend is definitely up in terms of companies using these. So here we talk about a new, inverted commas, strategy at the market. It's not new, it's been around since the 90s. ASX companies have looked at, inverted commas, similar structures. They have had access to the ways in which people can actually use similar structures. So CBA has used something similar. I say similar, it's actually not that similar, and the main reason is the control issue. So that's a really important part to come back to it. But the ATM, again, control. That's the really important point. The company keeps control. It has control over when, if is the big one, if it is utilized at all. And you can think about that like an option. The company has the option. Even though it may never utilize that option is still valuable. It's absolutely valuable. So the company is able to control. It's able to opportunistically, through that control, be able to raise capital at times which it suits it most, either because it's a $5 billion company that only wants to have $50 million, or it might want $10 million and it doesn't want to draw down on any more of its loans or rolling facilities or whatnot. Or it might be a very attractive price. It might be it might be a REIT, say, with a particular net tangible asset value of X, and it says, well, whenever we're above X plus Y, let's raise capital. Let's actually opportunistically take some money off the table. And so the next part of why ATMs are so attractive in the United States is because they're affordable. By comparing them to the more traditional secondary raising, the fees are substantially less. The discounts required in order to do it is negligible because it's at the market. Excuse me. It's at the market, so there's no effective discount. And the fees are typically between 1.5% to 2% for very large companies, so $50 billion plus companies, and then $9 billion companies all the way down. And so the smaller companies typically are charging brokerage, inverted commas, of 3%, 4%, 5%, which is still less, and I'm talking much smaller companies, still less than typically what would be raised. And what happens is here, I'm just noticing a number of questions coming in. Sorry, guys. I will get to them. If I don't actually, I'll get to them right at the end. I might just put those to the side. I don't know, Jeff, if you can sort of take those off my screen if possible, but that would be great. And I will come to those when I get there. And so it is transparent. And when I say it's transparent from the company's perspective. Unlike a reverse buyback, which is extremely transparent from the market's perspective, this is actually transparent from the company's perspective, as a reverse buyback is as well. And I mention this because from the company's perspective, a lot of these kinds of inverted commas structures that have been touted by investment banks here in Australia before don't have the transparency. It's typically, we're going to place it at VWAP and do this, and it's very difficult to actually understand how much money is being made by the bank, how much risk they're taking, versus how much money is actually being raised. And so unlike that, an ATM is very transparent. The price is set on market. That's the price, and then there's a fee. It's 1.5%, 2%. Done. And that's it. And again, because the company controls if they use it, they can very quickly decide whether or not that's something that is for them. And look, importantly, it's unrestricted. So people often, especially when we talk to smaller companies, think that having an ATM means that you then don't go and do a rights issue, or you don't go and do a placement, or you might not use some other structure. That really, the takeaway from this is that it is really a complementary tool, and in the United States, that's certainly how companies utilize it. There wouldn't be many companies, and I'm certainly not aware of any, that would only use an ATM to raise capital. It would be part of a much broader spectrum, including as part of their fixed income and bonds that they may or may not do. This here, and I don't usually describe things by stating what they're not, but this is certainly something which doesn't come up in the United States, but certainly comes up in Australia. If you give someone the elevator, inverted commas, pitch about an ATM, especially, funnily enough, in the small end of town, so the micro cap, explorer market, resource stocks, they very quickly think this is an equity line or a structured finance note. And that is absolutely not the case. It is absolutely not an equity line. It is not a structured finance note. It is nothing of the sort. There is never an overhang of stock. It's never, for example, an equity line where you get $1 million on day one, and then you've got to pay back $1 million, but you don't have $1 million, and then you've got all these shares that get issued in order to satisfy the debt. That's a very simplified version of an equity line, and that keeps on happening. Oftentimes referred to as a death spiral in the literature, because the company keeps issuing more and more stock, which is obviously, it doesn't control that, it's not allowed to, and it's very, very difficult to actually do that. And so it is actually something which there is no overhang. Again, I'll explain why as we move along. And look, if you, from a technical perspective, if you take away nothing else from this webinar, it's a reverse buyback. All right. From a technical perspective, economically, it's a reverse buyback. And just look, I am trying to ignore the questions that are coming in, but Tom P asked, did you say fiance or Beyonce? I've never met Beyonce, but my fiance, her name's Madeline. So thank you, Tom, for that question. My fiance and I met in New York. Thanks. Okay, so what does all that mean, like in terms of, you know, who uses these ATMs? Are they just small little companies, or who's using them? It's actually everyone. Everyone uses ATMs. So healthcare is obviously a big one. REITs, energy, finance. You can see there mining's a smaller part, and computer electronics, which is tech, obviously, and others. So all the sectors are using them. This information is actually from Third Capital Markets. It's actually just information from August. It's actually not looking at the entire universe of ATMs that have been used over a number of years. So finance, for example, would make up a bigger portion of that, as would energy, and as would resources as well. So you can see there, since 2010, 4,000 ATMs, 125 billion in gross proceeds. So huge, huge numbers. Make no mistake, this is the United States we're talking about, so the numbers are obviously commensurately huge, but at the same time, Australia is a very similar market, albeit just a little bit smaller, that's all. And so here's just a bit of this is also from Fifth Third Capital Markets, just to show these are the deals that were done over a 4-day period in August, so between the 8th of August and the 12th of August. And you can see there's a range of deals, $30 million ATM for rocket fuel with a market cap of 140 mil. And then you can see down with Plains All American Pipeline, which is under the third line down, there's a $541 million ATM with a market cap of 4.2 billion. And you can see Duke Realty there. So a range of different sectors, a range of different sizes, certainly not small companies, some of them smaller than others, but certainly, you know, they're quite large companies. So that's who uses these, and these are the sort of percentages in terms of capital that actually is being raised through ATMs. So you can see here, this is again through August. So the first one, through 2016. So that's the first month of 2016. You can see there's 50 deals done there, and the ATMs are the top blue ones. So you can see they're the ATM deals versus all capital raised through the other structures. And so you can see that common stock is basically like a placement, or what we would call a placement to sophisticated, which is the common stock part. So you can see a big part of the market there is being, ATMs are being used to actually raise that. As you can see, ATMs. I mentioned before about equity lines. Here they are, structured equity lines, often referred to as lenders of last resort, often referred to as death spirals. This is not what an ATM is. An ATM is not an equity line. ATMs are not equity lines. So it's just a very important takeaway for that. So who uses ATMs? Well, look, Bank of America, they're the biggest company to ever use an ATM. They offer ATMs as well and when I say ATM, of course, I'm referring to at the markets. They used an ATM to raise $13 billion in just 11 days in 2009. That was obviously part of shoring up their balance sheet as part of the GFC. They raised over $30 billion as part of that process, and you can see the ATM was over a third of that amount. So it's hugely important to their balance sheet and survival. Hopefully a position none of you are ever in, having to make decisions about that, but again, shows that the ATM's optionality in that case, we'll go back to that slide, shows the optionality there. It gave them the ability to do that, gave them the ability to otherwise raise that money when they otherwise couldn't tap enough from the more traditional markets. So here again, that's a bit of an extreme example, but it's not that extreme. Kinder Morgan, they're a energy infrastructure company here in the United States, $44 billion market cap. This is from a slide from their presentation, the fixed income presentation in 2015. You can see here they talk about their ability to be able to tap equity markets without underwritten offerings. They've actually, you can see there, they issued 0.8 billion and 1.2 billion respectively in 2014, 2013, so 2 billion over those 2 years. And they're saying here, as part of this presentation on their fixed income analysts, hey, we've got this ability under our ATM to raise quick equity capital should we need to. Not only that, they obviously use it opportunistically to raise equity capital, but they're also got this ability, it's a bit hard to see down the bottom there, but it implies that they could raise 1 billion of equity in 24 days, which is basically 10% of whatever they're trading per day. So, and that's roughly what you see here in the United States. I've just put this slide, or this picture rather, back in here with this table, just to show again, just to highlight the range of different companies and sizes that are using this. Again, this is from a 4-day period. There's no Kinder Morgan $44 billion company here, but there's a 9.9 all the way down to about 100 million. So again, a range of companies, all obviously listed, that are utilising these. Technology, finance, healthcare, the REITs, energy, and then a construction building one just thrown in for good measure. So again, a range of companies using these, a range of sizes, for a range of different reasons. Jeff, I've just got a very small video here just to show. It's actually a company CEO talking about how they utilise their ATM program. And so it's part of their broader capital management plan. It was taken a couple of years ago at a REIT conference. Hopefully that's going to be playing shortly. It only goes for a minute.
I'm Matt Bouchard with REIT.com here in Atlanta for REIT World 2014, NAREIT's annual convention for all things REIT. I'm joined today for the CEO Spotlight by Chris Marr, President and CEO of CubeSmart. Chris, thanks so much for joining us.
Oh, thanks for having me. It's been a wonderful NAREIT. Really appreciate the time and glad to be here.
Good. Now, your company recently held a successful equity offering. What are the proceeds of that offering earmarked for, and do you expect to raise additional capital in the near term?
So we've done a combination of equity raises this year. We've been active utilizing our at-the-market equity program, and then we did a follow-on offering earlier in October. Between the two sources, we raised a little bit over $400 million, proceeds of which have been used to fund our acquisition program, including a portfolio transaction that we closed on Monday of this week. We've also pre-funded all of our commitments for deliveries in 2015 under our build-to-suit program and under our joint venture development program.
Great. And how are the major fundamentals at work in your sector shaping up for 2015?
Oh, fundamentals look fabulous.
The video. Thanks, Jeff. Thank you. So we're back to the presentation here, and hopefully that just gives you a bit of a sense of how they view these ATMs. It's certainly not their only way to raise capital, but it is an important part of their toolkit in order to make use of the best use of capital markets. And so look, just to run through some very, very simple numbers here. If you look at the actual, so CubeSmart, that's its code obviously, between the 1st of Jan and 30th of October, so the period that he was actually just after being interviewed, is they had raised $273 million. It was part of their ATM, and you heard him talk about how much they'd raised in total. I think it was roughly 400 odd million. So 273 through their ATM program. That was actually at a price of $18.22. $18.22 versus a VWAP of $17.90. I'll explain how that works in a moment, but very simply, it's because the company can control when it's turned on, and by setting a floor price and saying, do not trade below X, therefore all the prices below X don't go into the times that they're actually raising capital. So they end up getting a price better than X, assuming that it trades above X. So all pretty straightforward. That was their market cap in May 2014, so when they were actually utilizing this structure. And then in 2015, they raised an additional $234 million at $26.35 versus, again, a VWAP of $25.44. So about 90 cents better than their VWAP. Again, amazing result, really, considering how they're able to manage that. The market cap at the moment is about $4.7 billion. So certainly a pretty good news story from that perspective, using their ATM effectively to manage their balance sheet, manage their capital in a very effective and very efficient way by not having too much capital on the balance sheet. You heard him talk about pre-funding their positions and being able to buy as they go and whatnot. Again, If they needed $500 million for something, well, then their ATM, in a very quick succession for a transaction, obviously the ATM, they wouldn't utilize it for that. But having it for these other reasons is obviously very useful. And here I just hopefully saw at the bottom of the slide come up, Moody's actually upgraded their unsecured bonds in 2014 as well. So it's worth noting that the ratings agencies think quite, all things being equal, like companies having access to these ATMs, because it does quickly, efficiently provide more equity capital should the need arise. So Fitch talks about it, Moody's obviously talk about it, and specifically as well as for sectors, ATMs being useful tools to help the companies manage their balance sheet. So what does that all mean? Well, what's actually happening here? Well, it's actually relatively straightforward. What's actually happening is that the company is simply entering into an at the market. So if we look at this slide, and unfortunately it's not animated, sorry, but it's quite simple. If you look at number one, the company has decided to enter into an at the market. It enters into an at the market, it discloses that to the market. Here, I've said it requests for the ATM to be exercised, but that doesn't need to happen. It can just enter into it. That could be the end of it, might not use it for a year, 2 years, may never use it. Fine, easy. In this particular example, just for the sake of it, it has actually requested to utilize the structure. Here we go, we're into the actual ATM exercise, and this grey period between roughly the 4th of April to the 17th of April, so the greyed out area, that's the valuation period. That's when the company has said, turn on the ATM. We're happy for the ATM to be on. And then what the company has also done is specified a floor price. So that red broken line across the $20 mark, it has said, only utilize this to the extent we are above, we're at $20 or better, $20 or better. So you can see where number 2 is, where those red dots are, red little squares, that is where it's above $20. That is where the ATM is turned on. That is where the ATM is being utilized to raise capital. And you can see, I think it's on the 11th of April, you can see that it's below the floor, it's below $20, i.e. ATM is not utilizing them. Again, on the 14th, same deal, it kicks back up to looks like the 16th of April, and then again, we're back above the floor, so we're raising capital. And then you can see these other dots outside the grey area, they've got nothing to do with it because the company doesn't want to be raising during that period. So the company specified all those things. At the end of that period, the third step there, the notice of the ATM exercise goes to the company. So the intermediary, so Acuity, for example, would turn around to the company and say, we are going to give you X dollars for Y number of shares based on the trading across this grey period above the $20 mark, And so you can see that's when that happens. The company, Acuity will provide the capital and the company will issue the shares. In this case, I'm saying here for the ASX company, they issue a 708A and Appendix 3B. So all pretty straightforward. Again, very quick, easy, cheap. They control how they're able to do it, and by controlling when it happens, you can see here that if we go back to the at the market example, CubeSmart, you can see that in 2015 they were able to raise at $26.35 versus the VWAP of $25.44, and that's simply because they had a floor somewhere in there that meant they missed some of the bad prices and got all the good prices above their floor. So quite simple, really. So that's how it works for the US, okay, but so what? Who cares? So let's use an Australian example to see if this could work for an Australian company. Okay, so here is an Australian company's trading. It's across 2016. This the solid dark blue line is actually the daily volume weighted average price. So the price it trades on market. And then the lighter blue broken line that's quite up and down, quite volatile, is the daily value of shares traded in millions of dollars. So So you can see it's roughly between 20 and 40 most of the time, up until about May, and then it kicks up a gear. And then you can see getting close to midway through September, you can see it actually goes off the chart. So a lot of trading at that particular point in time. So I've called this ABC Ltd. It's actually based on it's real trading data from a real ASX company. If anyone can guess who it is, you'll get a prize. I'm not sure what the prize will be. Maybe a Make America Great hat again, something like that. But also, a little hint, the president of the FTA should know who it is. Okay, so this trading here, they actually did a $400 million capital raise at $7.32 in April 2015. So I'm not using this to say that the ATM is better than that capital raise. It's clearly not. It's clearly for different things. I'm simply saying that to put in the context of they had a strong balance sheet, they had the capital that they required, it was all sitting there ready to go. Now, let's assume that they did that capital raise, and now let's assume we're actually back in January. We're back in January 2016. We don't know what's going to happen. We don't know where the share price is going to go. We don't know. We have no idea. So what we do is we decide, let's be prudent, and let's have this ability to be able to tap the markets if we so choose. Let's enter into an at the market. So we enter into, this company enters into an at the market. It announces that at the market to the broader market, obviously through the ASX. I noticed someone had a question about how the market is informed about this. That announcement informs the market that the company has the ability to be able to actually utilize this structure. And obviously the key terms are notified to the market. So the market is cleansed. There's no worry about that. There's no insider trading or whatnot. So hopefully that kind of issue answers that question. If not, feel free to shoot me an email. I can go into more detail. While I'm on that, Clayton Utes has provided our advice. It's quite a detailed advice that goes through all the various points step by step. So if you're interested in that information, more than happy to bore you to tears with it. So let's enter into this ATM. We've done that. The market then continues on. So we continue on, and then the company can see that its price is actually rising. The volume seems to be holding up very well. The company then at this stage decides, ABC Ltd decides to, let's utilize the ATM. Let's turn it on. So it initiates the ATM and it sets a floor price of $8.75, which basically means that it is prepared to issue shares at $8.75 or better. $8.75 or better, but at $8.74, it's not interested. So only prices above $8.75 is it interested in. So it sets that floor. That floor then goes through. Obviously, we don't know what's going to happen in the future. Well, we do because we've seen the map, the graph, but let's assume, again, as we would, we don't know. Here, anything in the dark blue does not raise. The ATM does not touch that stuff. It's not interested in that. It has nothing to do with that particular volume or price that goes through. However, light blue above the floor, that's when the ATM is being utilized. It's being actually, when it's being turned on, this is what it's able to do. So in this case, where the price has stayed above the floor, the ATM is able to raise capital at these times, unlike any other structure. So this is the trading that's going on market. The price has gone, and all the ATM is being able to do is utilize that trading to be able to raise capital at those peak times. Again, stress. The company has controlled this. The company did not have to turn this on. The company did not have to use it. Did not have to set a floor price of $8.75. It could have set a price of $9.25, and I'll come to an example on how that changes things. But that's how it's used. So this period through here, it is being able to raise capital. Where it's gone red there, none of that, you can see the price, especially in April, is below that red line. That is not being, the company is not raising capital at what it considers to be prices that it's not happy with. So here, as you can see, below the floor, no shares are hedged, inverted commas hedged, and also the ATM can be turned on or off at any time. So here, across this period, the ATM, what it's done is it's raised $220 million at a raised price of $9.23.2, 9.232, versus an actual VWAP of $8.95. And the reason why that is again because all the prices below $8.75 don't get factored in, which drags the price down if it did to $8.95, and it only takes prices at $8.75 or better. So it means that $9.23 is the price that we've been able to raise capital at. So here's just some quick scenarios. We'll just run through them very quickly just to get a very good feel for how that works. This is the scenario above. The floor price was set $8.75. The intermediary has and the group has confirmed a target daily volume of 7.5%. So if $100 million went through on a particular day, this structure would try and target 7.5 million, assuming it was above $8.75. So easy. So what that means is across that period, 23,855,664 shares are hedged or sold. They're actually sold on market at that particular point in time over that period. And you can see there the volume weighted average price they were sold for was that $9.23 we talked about, $9.23. And you can see that there is actually 3.2% above the VWAP, And so that means, you can see the VWAP there, $8.95, $8.95.3. And you can see there for a total raise of $220,257,460. So that's done is we sold, if you think about it, we sold shares at $9.23.2 and we sold 23 million of them to raise $220 million. Easy. All right, let's just quickly run through this part here and let's look at a different scenario. In here, the target daily volume percentage traded remains the same, except we don't have a red line now. We don't have a floor price. The company's just said, look, turn it on. We'll take 7.5% between the 1st of April and the 30th of September. Done. Now you can see that we sell a lot more shares because we don't have the barrier of the floor price in there. So we now sell 36 million shares, 36,397,295. And we sell them at $8.95, the VWAP, the actual VWAP. So we're not doing anything magical here. We're not beating the VWAP. We're just getting the VWAP. And again, this is just to illustrate. Obviously, Bank of America didn't have a floor when they just tried to raise $13 billion, but typically there will be a floor. But just to illustrate, so this is trading 7.5% of the volume each day with no floor, and we end up selling 36 million shares to raise a total of $325 million across the same period. So exactly the same parameters, except no floor, So scenario 3, this is again, what we've done here is we've kept the floor price at $8.75, and all we've done is increase the targeted daily volume to 10%, and you can see there that's 10%. You can look at the VWAP, it's still $8.95, and then the ATM traded price is the same as in scenario 1. It's $9.23. Now, 10% is the magic number in the United States for large companies. They will trade up to. I'm typically a little bit more conservative and prefer to run my numbers on 7.5% of daily trade, but 10% is the rule of thumb. Funnily enough, for smaller companies, they'll actually up that to 20% around news flow. So when news flow is strong, so they're an oil and gas explorer, they're spudding a well, the price is running up as the market starts anticipating whether or not there's hydrocarbons, they'll actually sell into that spike and be more aggressive and take 20%. But for big companies like this, 10% is a nice number. So you can see there, exactly the same scenario 1, except we sell more and we're there at 293 million. Scenario 4 is an interesting one. I mentioned before. Here, what we've done is we've raised that red line up to $9.25. So the company has now said, look, I'm not happy with $8.75. I only want $9.25 or better. Still happy with 7.5%, but I want $9.25. That actually increases the VWAP because now I'm missing not only am I missing prices below $8.75, I'm missing everything below $9.25. So therefore my VWAP, my ATM traded price gets dragged up. So the average price I'm selling stock, it gets dragged up, which means I'm now 6.33% above the VWAP, which is, you know, obviously a huge result. If you think about that in terms of how Warren Buffett likes to talk about when companies are raising capital, when you value the whole company, you should be valuing the whole company in the same way that, you should be valuing the smaller part of the company to sell off as you do the whole. If you had a company which was 6.33% more valuable doing something particular way, that's obviously a fantastic result. So it also valuable doing something particular way, that's obviously a fantastic result. So it also means, though, that we don't sell anywhere near as many shares across the period because we've got that higher price we've got to overcome, which means we raised less. But again, the company controlled that. The company said, I don't want to raise at $9 or below $9.25, and I only want to, maybe in this case, I wanted to top up its DRP, have an extra $100 million, who knows. So scenario 5 I won't even bother with. All it is, you can see the thing is 5%. The target's daily volume percentage traded is 5%. So it's half of scenario 3. And funnily enough, ATM shares hedged is exactly half. Total ATM raise is exactly half scenario 3. So no surprise there. And then scenario 6 is just to show this particular stock, ABC Ltd, we're calling, never traded up to $10. So here I'm just showing that at $10, we don't sell any shares, we don't hedge any shares, and therefore no capital is raised in this circumstance. So the floor, the red line, has gone above everything, and there's nothing happening there. So again, it's quick, it's easy, it's efficient. The company is able to control all these scenarios. The company is able to totally control, and it's not like it's static. It's not like once it's set, that's it. You can change that floor as you go. So let's say in scenario 4, they set it at $9.25. They actually wanted at least 150 million, and so they dropped the floor down to $9 for the last 2 months. I'm just making this up, but as an example, you can change things to suit your outcome that you're actually trying to achieve. So again, and that allows that opportunistic way to actually raise capital. So it does work for ASX companies in terms of the economics, and why wouldn't it? It's exactly the same economically as the United States companies. There's no difference there. So of course it works. So how does it work in terms of ATMs for Australia? Well, that's what Acuity has done. We've come up with a structure, as I said, that the ASX has looked at it. Clayton Utes has signed off on it, and we have put in place this structure with over 20 deals here on the ASX to look at that. Step 1 is to enter the ATM and announce it to the market. Okay. Now I can go into a lot more detail if someone would like offline about this sort of stuff. What this actually is, we call it an at the market. It's actually a contingent moving strike option. So legally, this is all very complicated, but it's all I guess very straightforward in a sense. So this is a listed corporate. This is our ABC Ltd. Okay, it enters into the ATM. We're going to say it's with Acuity. And look, Acuity, because in this particular instance, it's a larger corporate, and there's actually going to be quite a bit of trading required, we actually need a balance sheet, and Acuity's balance sheet's too small. So we enter into stock lending and custodial arrangements with an investment bank. Our investment bank partner, you can probably gather by the shape and colour who I used to work for. Obviously, it's left an impression, but they are obviously guys who we deal with. So even though Acuity here is the entity that is facing the listed corporate, the investment bank, because of the custodial arrangements, is actually the true entity facing the corporate. So here, what we've done is we've entered into this ATM, we've announced it to market, we've got these arrangements all, and again, what happens is, again, exact same data that we had before from our ABC Ltd. We've gone in there, we've entered into the ATM back here at the beginning of 2016, exactly the same. And now what we're going to do is step 2 is we're going to utilize the ATM. Again, no requirement to do that. And I'm probably laboring on the point, I'm sorry. There's no requirement to do it. They don't ever have to use it. They can tear it up and never look at it again if they choose. But in this case, the ABC Limited, ASX listed corporate, has decided to exercise or request an exercise of their ATM. So they do that. What they specify here is the floor price. Again, we're going to use $8.75. We're going to say a maximum number of shares of 25 million, and the period is the 1st of April to 30th September, and a maximum raise. I've put it here, not applicable, just for simplicity. The company can actually say, once you hit X dollars, stop. We do not want anything more than 50 million, 100 million, 200 million, 5 million, doesn't matter. And all those parameters, the company again decides, it chooses. It could have a floor price of $8.50, $9.25, whatever it wants. Nothing happens until that request is received. That request goes in there. You can see the floor price again, it's at $8.75. It's sitting there, that's that red line. Then what happens is the next step in the process is that Acuity hedges the position on market. So you can see here, what we do is we give instructions to the investment bank partner to execute the hedging, exactly the same as what happened before. There's our $8.75. There's the market going along. We're raising it above above the red line in that highlighted blue section. All we're doing is the investment bank is simply selling into that market at 7.5% of daily trade when it's above $8.75. So very, very simple, very, very simple from that perspective. All it is doing is selling into that market when it's above $8.75 up to 7.5% of the daily volume. That's it. That's all it's doing. What does that mean? It means that the position the bank now holds, or Acuity holds through the investment banking custodian, is we have sold 23.8 million ABC shares at $9.232, which is our scenario one from before. So if you go back to scenario one, this is exactly what has happened. The investment bank has sold 23.8 million ABC shares at $9.232. It now has $220 million cash, but it's short 23.8 million ABC shares. That's what it has. So that's the position we're in. Acuity / investment bank custodian is now short 23.8 million ABC shares and long cash. It's got 220 million cash. How does it get back to square? That's what it needs to be. It needs to be back to square. All it does under the ATM, it issues the exercise notice. And this is obviously what the ATM agreement talks about, and that's why it's referred to as a contingent option. We're effectively exercising this option. And that goes through from Acuity to ABC Limited. And that notice says you must issue us 23.8 million ABC shares at a 2% discount to the price we traded, which was the price above the floor, whatever it was. Here it's $9.232, a 2% discount to that price. So in exactly the same way that they would normally issue shares, the price here has been given a floor by the company, and the price is $9.23.2 minus a 2% discount. And unlike the US where it's a 2% brokerage fee, here in Australia, the way we've structured it is as a discount. So it's a discount being issued to Acuity. We then obviously will settle this. It's a simultaneous settlement here, and so exactly the same way as an options exercise or a placement's done, there is 23.8 million shares comes to the investment bank custodian, and Acuity, or the investment bank custodian, pays across 23.8 million shares times 9.047, which is the issue price, for a payment of $215,830,776. And that is how the company is able to, by it controlling the floor price, by it controlling the period, by it controlling if it's utilized, it's able to control exactly when this structure is utilized and how it's utilized, and to achieve this outcome. And so if you think about this as well, you look at that and you go 2% discount, okay, that's the fee, but also factor in, you're able to get a better price than what you were prepared for, which is $8.75, by riding that wave in the market. Now, of course, if it never traded $8.75, or we set the floor at $10, then at this period, there would be no shares sold in market. the company would issue no shares and we would give the company no money. But again, the company has decided that price. It can lower the floor. It can control if it utilizes it or not and when. So that, again, allows the company to control exactly how this is utilized and when. So, again, very efficient in that sense. No roadshow, no stuffing about, no underwriting fees, no placement fees, no deep discount, no discount at all except the 2%, which is the fee. So that's how for the ease of use this is done. And again, opportunistically being able to be turned on. So what does that actually mean? Well, as I said before, it's a 3.1% premium to the VWAP, which means obviously with the 2%, it's a 1.1% premium to the VWAP. So I don't know if anyone's read the Daniel Kahneman book, Thinking Fast and Slow. It's a very long book actually. It's very interesting, but the main takeaway from that book is that people aren't fantastic at statistics, and being able to use tools like this allows us to negate our own inabilities to choose the best possible time. So it's the whole idea of averaging into your own price. So oftentimes when you're told to, or you're looking at buying shares, someone will say average in over time because you don't know the best price. The flip side is also true. When you're selling, having a tool like this that you say, okay, at a minimum I need this, but anything above that I'm comfortable with. That's what this tool allows. And so, again, just for comparison purposes, and this often happens, when they're used here in the US, the issue price of $9.47 is a 13.8% premium to the closing price because that price continues to go up. In the same way as the 15-day VWAP, it's a 20% premium to the 90-day VWAP, again, because that price is going up. And it's a premium of 23.6 to the capital raise in April 2015. Again, it's an unfair comparison, to be honest, with the capital raise, but I use that just simply to show, in terms of balance sheets and making sure your balance sheet is as tight as possible, if there was a way, for example, that particular company needed to buy an office tower and it cost $400 million, they raised $400 million, well, then that's a perfect use of that capital. Great. But if it's more incremental, where they needed, say, $250 million, but they needed another $150 million across time, then maybe a more efficient use of that would be to actually raise the $250 and then over time chip into their own through the ATM. And again, no reason just because you've got the ATM that you have to use it. If things turn for the worse or something happens, you've got all the normal, usual tools that we talked about in the very first slide available to you. So, look, this is my details. That's really the end of the technical part of the presentation. As I said, my details, I am based in the United States, but I'm over in Sydney all the time, being home, obviously. Look, these are some dates that I'll be there in November. If you've got information, if you'd like more information in relation to how this all works, more than happy to set up a time when I'm in Australia or have a chat over the phone. I'm usually up pretty late in New York time to work Australian hours. So yeah, hopefully you found this worthwhile. I think the guys will make the slides available. I'm not exactly sure, but otherwise there's my details. Or feel free to go to the Acuity Capital website. This is only the second ever webinar I've ever done. The first one was for about 10 minutes, much simpler topic. I have to admit it's been quite difficult sitting in a room just talking to yourself, so without any feedback. So hopefully that was useful and educational. And as I said, if you take nothing else out of this particular talk, from a technical perspective, it's a reverse buyback. From a useful perspective, it is absolutely a complementary tool that you can utilize for any number of different scenarios, and it's a tool which can be used in conjunction with other ways, and obviously here in the United States, used significantly. So look, I've got some questions here that I'll just go through, so that people want to. I'm not sure if everyone else can see them or how that works, but I'll just go through them very briefly. So the first question is from Poe. how does this get around the laws, rules by attempts of price fixing by companies? So I'm not exactly sure what you mean by price fixing. There's certainly no price fixing, but the way that this structure works is that the company enters into the arrangement with Acuity, for example, and that arrangement is disclosed to the market. The market is then cleansed of that information. So in this case, for example, with ABC Ltd, there would be an announcement to market saying that the ABC had entered into an at-the-market which provided the company the ability to be able to raise up to X million, in this case let's call it 300 million, of equity capital at a time, price, volume of our choosing over the next, say, 2 years, just as by way of scenario. The market is then informed that the company knows that Acuity, that the company can request capital based on a period over time at a 2% discount to whatever the VWAP was across that time. So hopefully that answers your question. Tom P, is this adverse selection by the issuer? Does the copy have to announce when it has issued? Company. So okay, yeah. So the honest answer is, Tom, absolutely. Anytime you're talking capital management, there is companies here in the US that there is an adverse reaction to having raising capital. However, the research shows that it is significantly less putting an ATM in place than a more traditional at the market. Sorry, not at the market. A more traditional capital management strategy. So that is what the research shows. And does the company have to announce when it has issued? It does have to announce when it's issued, absolutely, and it has to announce before it enters into the arrangement as well. Now, the 20-something deals that we've done here in Australia, only one company has gone down on the day of an announcement, so that's obviously very positive. That company also wrapped up the what is in the small cap land, the small company land we refer to as a controlled placement agreement, not an at the market. For at the markets is only for larger companies in Australia. That company also announced a quite a significant package of a JV and whatnot. So question whether or not the structure was what caused the company to go on down that particular date. So, but other than that, there's no announcement required until such time as the stock is already placed. So if you think about the way the structure works, the company requests the exercise of the structure, Acuity and the investment bank executes that, and then post that execution is when the simultaneous settlement happens. That is when the company will turn around and say it's just utilized, it's at the market. So when I talked before about transparency, very transparent from the company's point of view, but the market isn't aware that it's being utilized. It's just aware that the ATM is there and the company could use it at any point in time. So that was that question. Shane asks, hi Stephen, you're probably getting to this, but how does the company deal with the impact of dilution and how they get around the legal side of things in terms of having to prove the public were aware of the offering, potentially forcing the share price down? Well, hopefully I've answered the second part of that. The company makes the public aware of it by announcing the structure, so the at the market to the market. It announces it, so the market is informed, it's cleansed, it knows the company could be utilizing this. In terms of impact of dilution, well, that's for the company to utilize the best possible means of raising capital, and that obviously means that the least amount of dilution as possible, whether that's because they're raising less capital issuing less shares at a better price to raise the same amount, or if they're raising less at a worse price. So this is the other advantage of this kind of structure, is if you're trading at a bad price and you only want $5 million or 50 million as the case may be, and you don't want to raise 500 million at a bad price, then this structure allows you to just take a little bit off the table. So that there in and of itself is one example, and then obviously go through those scenarios, and you can see that and the case studies from the US, they're often raising it better prices, which means less dilution. And the whole idea behind raising capital is to invest at a return which is acceptable for the shareholders, and so ideally you want to reduce that cost of capital as much as possible and get the best possible return. Tom, we've already dealt with your other question. No, it's not Beyonce, my fiance. Thank you. Poe, the video did not show. I'm sorry about that, Poe. I don't know what happened. Poe also asked, in a practical sense, does that mean the ASX listed company issues the shares and hold on to them on the announcement date, so the market is informed that the issued shares will be the shares that will be sold into the market come the ATM? No. So good question, but no. So the way the structure works is the reason, and depending on the company. So the reason why we need the investment bank, the prime broking desk, is that we actually borrow stock in that case. So the company doesn't issue anything. The company doesn't issue anything until such time as we've actually done the deal. So when we've actually, executed the hedging of the position. So to use our example, the company requests capital. It says we will issue up to 25 million shares at no less than $8.75. We, in the investment bank, effectively borrow 25 million shares. We sell those on market up to 7.5% per day at no less than $8.75. And then at the end of the period, we turn around and we say, okay, those 25 million shares, we actually sold 23.8 million of them. Now we need to give back 25 million. The prime broker needs those shares back, and that's when they exercise the ATM. The ATM then, the company then issues the shares, 23.8 million under the ATM. We then give them the 215 million. They've just done a raise at the market price, subject to the floor of $8.75, minus a 2% discount, and they've beaten the VWAP. And Acuity and the investment bank have made money out of providing the service and the expertise and all that stuff behind the scenes to make it all work. And obviously the fee of borrowing the stock is not insignificant, and that's what that 2% goes to cover. So unless anyone else has got any further questions, and look, again, feel free to email me or get in touch, give me a call. It is 10:30 here in New York, so maybe give me a call tomorrow. AM's best, Sydney time or Melbourne time. Otherwise, thanks very much, everyone, for dialing in. Hopefully it was useful. Jeff, I'm not sure if you want to just wrap up or...
Thank you, Stephen, for a fantastic presentation, and thank you to everyone for attending our webinar. Just a quick reminder, this webinar was recorded, and you will receive a copy of the recording and a copy of the slides in the next few days. Thank you for participating. We hope you have a wonderful day, and we hope to see you at another FTA webinar soon.